There is a very specific, almost ritualistic art to brewing Turkish tea. It is deceptively difficult.
Oh, absolutely.
You have to let it steep. You have to give it time for that color to turn into that perfect, deep rabbit's blood red. But there is a line, a very fine line.
It is all about timing.
Exactly. If you leave it on a heat just a little too long, or you mess up the water ratio, suddenly it's not strong. It's bitter. It becomes undrinkable. And that is the metaphor we are working with today. We are looking at Orçay, Ortaköy, Si Sanayi ve Tikuri. This is a company that has been steeping in the tea sector for decades. But looking at their 2025 financials, we have to ask, is this a strong brew that just needs patience? Or has the financial heat been turned up so high that the investment has turned bitter?
It is the right question because looking at this report, this isn't the same company it was 12 months ago. The scale of the change on the balance sheet is massive. They've effectively rebuilt the foundation of the house while trying to live in it.
Well,
Good to be here.
So here is the mission. We are taking the Orçay 2025 annual report and financial statements, and we are stripping it down for the individual retail investor. We aren't institutional fund managers here. We are looking at this from the perspective of someone buying shares on the app.
Right.
And to make this crystal clear, because let's be honest, looking at millions of lira in a high inflation environment is dizzying, we are going to convert the key figures into US dollars.
Which is crucial. We're using the report's year-end rate of roughly 42.85 lira to the dollar. It really helps strip away the inflation noise so we can see the actual purchasing power.
Let's first get to know the company a little. Orçay isn't some tech startup. They've been around since 1985.
Right. They are heritage players. They are based in Rize, specifically the village of Ortaköy. If you know anything about tea in Turkey, you know Rize is the epicenter. It's where the climate is perfect for it. Wet, humid, steep hills.
And I think most people, when they see the ticker symbol or the name, they assume, okay, they grow tea, put it in a box, and sell it to Migros or Carrefour.
They do that, but that's actually the smaller part of the story. They produce dry tea, yes, but their business is split into two main buckets: bulk tea and packaged tea.
Okay.
They also dabble in some niche products like green and white tea, but the core engine is black tea.
I was surprised by how small the team is. For a company listed on Borsa Istanbul, the headcount seemed, well, light.
It is incredibly lean. They average only about 72 employees.
72. That sounds like a medium-sized restaurant, not a publicly traded manufacturer.
It speaks to a couple of things. One, the mechanization of the factory, but two, the seasonality. Tea harvesting happens in waves, May, July, September. They ramp up and ramp down.
Wow.
They aren't maintaining a massive standing army of workers year-round, and they likely outsource their logistics. They aren't running a nationwide fleet of trucks themselves.
Before we get into the money, let's look at the people signing the checks. The governance. Who owns this thing?
It's a mix. It's publicly traded with a very high free float. About 62% of the shares are out there in the public's hands. That's high.
It is high.
But the anchor ownership is the Erdoğan family. Mehmet and Fatih Erdoğan each hold about 14.4%. So nearly 30% is tightly held by the family. They are the captains of the ship.
And are the captains paying themselves a fortune while the ship navigates these choppy waters? I always check the key management compensation line.
I checked that too. The report lists the total benefits to top executives and the board at 6.44 million TL.
Let me do the math on our exchange rate. That's about $150,000 USD.
For the whole year, for the entire top team.
That is surprisingly modest.
It is. In a world where we see executives looting the coffers, this is reasonable. They aren't getting rich on the salary line. They are aligned with the share price.
Okay, that gives us the character of the company. Lean team, family-owned, modest executive pay. Now let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats, before we dive into the hard numbers. What's the high-level view?
Strengths. Location and assets. They are in the tea hub, and as we will see, they now own a massive amount of real estate and machinery. Weaknesses. Profitability and debt. They are losing money, and they owe a lot of money.
And the opportunities.
Scale. They have made a move to get bigger. If they can fill their new capacity, they can potentially lower costs and shift to higher margin products.
But the threats are lurking.
Inflation accounting hits them hard because it distorts the numbers. Rising interest rates are a nightmare for a company with this much debt. And of course, they are agricultural. If the harvest in May or July is bad due to weather, the whole year can be ruined.
Okay, we know the players and the field. Now we can move on to our analysis. Let's open the books.
Let's do it.
We always start at the top. Revenue. Sales. How much tea did they actually move?
In 2025, they brought in 661.6 million TL. In dollar terms, that's about $15.4 million USD.
And that's up from last year, right?
It is. The previous year was around 579 million TL. So top line growth is there. They're moving product.
But here's where I want to push back a bit. Revenue is vanity, profit is sanity, right?
Right.
When you look inside that revenue number, does the quality of the sales hold up?
This is the most critical insight in the revenue section. You have to look at who they are selling to. Out of that $15.4 million in revenue, roughly $13.3 million came from bulk tea sales.
So the vast majority.
Over 85%. And packaged tea, the brand name boxes you'd see on a shelf, was only about $2.1 million.
Why does that matter to me as an investor? Money is money, isn't it? If I sell a ton of tea in bulk, I still get paid.
You get paid, but you don't get paid well. Bulk tea is a commodity. You are selling to other companies, maybe even competitors, who are going to blend it or package it. You have zero pricing power.
You're just a price taker.
Exactly. You are at the mercy of the market price. Packaged tea is where the brand loyalty is. It's where the margin usually lives. Orçay is effectively functioning as a wholesaler, not a consumer brand.
And wholesalers operate on razor-thin margins. They're moving volume, but they aren't keeping much of the slice.
Precisely. And that shows up immediately when we scroll down to profitability.
Let's talk about that, because when I looked at the bottom line, it wasn't pretty. But walk me through the steps. Gross profit first.
Gross profit was okay, about $3.4 million USD. It's actually up a little bit from the previous year. But when we get to operating profit...
Right, the money made from actually running the tea business, paying the staff, paying the electricity before paying the bank.
It dropped. It fell to about $2.45 million USD.
So despite selling more tea, they made less money from the actual operations.
Efficiency slipped. Costs rose faster than they could raise prices on that bulk tea. Inflation in energy and labor probably ate that margin up.
And then the net loss. This is the number everyone looks at.
A deepening loss. Orçay posted a net loss of 161.4 million TL. That is approximately $3.76 million USD in the red.
Hold on. Let's trace the money for the listener, because this is where it gets confusing. They made an operating profit of $2.45 million. They actually made money making tea. How do you go from making $2 million to losing nearly $4 million? Where did $6 million go?
One word. Debt.
The bank came calling.
Specifically, financial expenses. They paid out nearly $5.57 million USD just in financial expenses. Interest payments, loan servicing. The cost of their debt completely ate their operating profit alive and then dug a hole in the floor.
That is a massive red flag. If your interest payments are double your operating profit, you are working for the bank, not for the shareholders.
Precisely. Every cup of tea they sold, effectively the profit went to pay interest on a loan.
But why do they have so much debt? Or say, isn't a tech company burning cash on R&D? They grow tea. Why is the debt load so heavy?
This brings us to the elephant in the room, or maybe the factor in the room, because if you look at the balance sheet, the total assets number didn't just go up, it exploded.
I saw that. Total assets jumped to 2.29 billion TL. In dollars, they're sitting on $53.5 million USD in assets. That is nearly double the previous year.
A company that is losing money doesn't usually double its assets unless they make a massive bet. And that is exactly what they did.
They went all in.
They went shopping in their own neighborhood. They bought a massive facility factory, land, machinery, and Adair, Rise.
Who did they buy it from?
A company called Of Saison.
And the price tag.
The total valuation was roughly $20.5 million USD.
Stop for a second. This company had $15 million in total revenue.
Right.
And they made an acquisition worth $20 million. That is aggressive.
It's transformative. It changes the entire thesis of the company. The valuation reports break it down. The land alone is valued at roughly 586 million TL. The buildings are another 242 million.
Okay, so they bought a huge factory. But we just established they have no cash. They're losing money. How did they pay for a $20 million factory?
They didn't take cash. They bought it on credit. If you look at the liabilities section, there is a specific payable to Of Saison related to this purchase. It's split between short-term and long-term, but it totals that huge purchase price.
So they basically took out a seller finance mortgage.
Effectively, yes. Plus, they have about $12.2 million USD in traditional bank loans.
This sounds like a high-wire act. They have huge debt, they are losing money, and now they have this massive factory to fill.
And that leads to the scariest part of this report for a retail investor. The liquidity crunch.
I looked at the current ratio. For listeners who don't know, that's basically comparing what you have in your pocket right now versus what you owe in bills over the next 12 months.
Ideally, you want to have more in your pocket than you owe. You want a ratio above 1. You want to know that if all the bills came due, you could pay them. Orçay is upside down.
Give me the numbers.
Their current assets, cash, inventory, stuff they can sell fast, is about 789 million TL. Their short-term liabilities bills due within a year are 853 million TL.
So they are short about, what, $1.5 million USD just to break even on their bills this year?
Yes. They owe more than they have liquid.
What about cash in the bank? Do they have a rainy day fund?
Not really. Cash and cash equivalents ended the year at roughly $870,000 USD.
Less than $1 million in cash against nearly $20 million in short-term bills. That keeps the CFO awake at night.
It means they are living on the edge. They have to roll over that debt or sell inventory incredibly fast or raise more money from shareholders.
Which they actually did, right? I saw something about a capital increase.
They did. They pulled the lever called a bedeli, or a rights issue. They increased their paid-in capital from 80 million TL to 240 million TL. Basically, they went to investors and said, we need more cash.
And the investors gave it to them.
They did. But even with that cash injection, the liabilities grew faster than the equity because of that factory purchase. The hole was dug faster than they could fill it with sand.
So let's look at the net assets, shareholders' equity.
It's sitting at about $16.6 million USD. So technically, the company is solvent. If they sold everything tomorrow, the new factory, the land, the tea, they could pay off the debts and have money left over. They are asset rich.
But they are cash poor.
Extremely cash poor. It's like buying a mansion but not having enough cash to pay the electric bill. You have a lot of wealth on paper, but you can't buy lunch.
I noticed the auditor had something to say about this too. It was listed as a key audit matter. Usually auditors just sign off and leave. When they flag something, I listen.
They flag the fair value of tangible assets.
Translate that for us.
Because so much of Orçay's value is now tied up in that land and building in Ayadir, the auditor is nervous. They have to double check. Is this land really worth what they say it is?
Oh.
Because if the real estate market in resize softens, or if those valuation estimates are too optimistic, Orçay's balance sheet takes a massive hit.
So the auditor is saying, this company isn't just a tea company anymore. It's a real estate portfolio, and we need to be sure the real estate is worth it.
Exactly. If you remove the revaluation of the land, the picture looks much, much uglier. The profit story relies heavily on the asset story.
Let's look at the fine print, the footnotes. Anything hiding in there that we should know about?
2 things caught my eye. First, related parties. There are significant trade receivables money owed to Orçay from related companies. About 84 million TL is owed by a company called Aden Pellet.
Aden Pellet. That sounds like fuel.
Likely fuel for the tea drying process. But having that much working capital tied up with a related party is inefficient. Why haven't they paid? If Orçay is so short on cash, why are they letting a related company owe them 84 million TL?
That is a great question. And the second thing?
The mortgages. The report notes there are mortgages on that new factory in Ayadir from the previous owner. They are in the process of being lifted or resolved, but legally it's a bit messy. The title isn't perfectly clean yet, though protocols are signed.
It feels like they are juggling a lot of balls at once. New factory, messy titles, huge debt, low cash.
It is a transition year, a painful one.
So let's try to summarize management's game plan here. Because they aren't doing this to lose money on purpose. What is the upside case? What is the vision?
The upside is scale. They're betting the house that this new factory allows them to process tea at a volume they never could before. If they can fill that capacity, maybe they can lower their unit costs. Maybe they can push harder into packaged tea because they have better facilities.
So the bet is, we take the pain now, we swallow the debt, but in 3 years, we are the dominant player in the region.
Correct. They are trying to grow their way out of debt. They are playing an asset-heavy game.
But the downside?
The downside is that interest rates stay high, the debt servicing costs continue to eat all the profit, and they run out of cash before the new factory starts paying off.
Inflation accounting plays a role here too, doesn't it? It muddies the waters.
It does. High inflation forces companies to revalue their assets upwards. That makes the balance sheet look stronger. Hey, our factory is worth double now. But it doesn't put cash in the bank. In fact, it can sometimes create tax liabilities on paper profits.
So it's a trap.
It can be a trap for inexperienced investors who see asset growth and think profit growth. They are not the same thing.
Before we get to our final verdict, I want to take a second to ask you, the listener, for for a small favor. We're going through these reports line by line so you don't have to. If you're getting value from this analysis, please hit that like button. It really helps the algorithm find other investors like you.
And make sure you are subscribed. We have a lot more deep dives coming up, not just on tea, but on energy, tech, you name it.
Also, if you want to support the channel directly and help us keep the lights on, kind of like Orçay needs to do right now, please evaluate our channel membership options. Or, if you're feeling generous today, you can use the Super Thanks button right below the video.
Every bit helps us dig deeper.
Okay, let's wrap this up. We have a company, Orçay, that is growing revenue but deepening losses. They've transformed their balance sheet by acquiring a massive amount of real estate and machinery, but they drown themselves in short-term debt to do it.
That is the summary. High risk, high asset base, low liquidity.
So here's the question I want to leave you with, and I want to hear your answer, expert. If I'm a retail investor, am I buying a tea stock?
That is the ultimate question. Investors really need to decide what they're buying here. Are you buying a tea production company? Because if you look at the operations, the margins are thin, it's a commodity game, and the interest payments are eating all the profit. There is no earnings story here right now. The EPS is negative.
So what are you buying?
You are buying a portfolio of valuable real estate in Rosés that just happens to smell like tea. You are buying the dirt and the concrete. The book value is there, the net asset value is there, but the cash flow is not.
That is a great way to frame it.
Yeah.
You're buying a distressed real estate asset with a factory attached.
Exactly. With a net loss of nearly $4 million USD and a severe liquidity crunch, the value isn't in the P&L, it's in the assets. The question is that enough for a retail investor to wait out the storm? Or is the brew going to get too bitter before it gets better?
A bitter brew or a long steep? That is the gamble with Orçay. Thanks for listening, everyone. We'll see you in the next deep dive.